Hello everyone, I'm Miles. Pick up your pen. Today we're going to learn some challenging finance cases in Solve to Learn problem solving. Today's case is the company hires a new employee with a total cost of $100,000. At the same time, depreciation expense decreases by $100,000 and the tax rate is 20%. The question is, what is the overall impact on the three major financial statements? We start by looking at the income statement, the profit and loss statement. Then changes in the income statement will be reflected in the cash flow statement. And finally, we check if the balance sheet is balanced. Step 1, income statement. Salary expense increases by $100,000 and depreciation expense decreases by $100,000. Pre-tax profit unchanged, net profit same. But the real trick is in the cash flow. Step 2, cash flow statement. Important formula for the cash flow statement. Operating cash flow equals net profit plus depreciation minus changes in working capital minus capital gains. CFO equals net income plus depreciation minus net operational working capital minus capital gains. Plugging in the numbers. Net profit hasn't changed. Depreciation decreases by $100,000. $100,000 less in non-cash add-backs. Working capital doesn't change. Capital gains don't change. The result is CFO equals 0 plus negative $100,000. Negative $100,000. Why is that? Because wages are actual cash outflows, which are already reflected in both net profit and cash flow. Depreciation is a non-cash item and is usually added back. But now that depreciation has decreased, there's $100,000 less to add back. So operating cash flow, or CFO, drops by $100,000 as well. Step 3, the balance sheet. Finally, looking at the balance sheet, cash decreases by $100,000. A decrease in depreciation means accumulated depreciation is $100,000 less as well. Net property, plant, and equipment PPE increases by $100,000. So total assets have no change, liabilities remain unchanged, and equity remains unchanged. Because net profit hasn't changed, retained earnings haven't changed, and equity hasn't changed either. The balance sheet still balances. The key point is that not all expenses play the same role across the three major financial statements. Cash outflows like wages directly reduce cash, while non-cash expenses like depreciation are only adjusted on the bridge from net profit to operating cash flow. So even if net profit doesn't change, CFO, cash flow from operations, might still decline. The key is to understand how this bridge converts accounting profit into real cash. If you grasp this bridge, you'll truly understand the pulse of a company's finances.